Hello and welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Thomas Moore, Fund Manager of the Aberdeen Equity Income Investment Trust. Thomas, thank you for coming in today.
Hi Kyle, good to be here.
So Thomas, to start off with, could you give an overview of your investment process, and could you talk us through the key qualities that you're looking for when investing in UK dividends?
Right, well that starts with the investment objective. So we're looking to achieve an above average yield. So I want high yield, but I also want growth. I want dividend growth, and over time I also want capital growth. So the types of companies that we select for our portfolio need to fit those criteria. And at the moment we're finding lots of companies that are generating lots of cash, using that cash to buy back their shares, pay dividends, and also invest in the future of their companies.
We've seen over the past 12 months, the UK stock market performance, it's been fairly choppy, but we have seen some strong short-term periods as stock markets have reacted to the prospect of lower interest rates. Has that been the key driver, or has there been more to it?
Yeah, the last 12 months, wow, I mean, what a roller coaster we've seen. We saw really a sharp improvement in the performance of the stock market in the run-up to the general election. And if you think about the reasons for that, the first reason was actually interest rates were thought to be coming down quite dramatically. And then secondly, people were looking ahead to potentially a period of greater political stability. Now, after the general election, a couple of things have happened. Firstly, inflation's proved quite sticky. So interest rate expectations, although we're still expecting a couple more base rate cuts, it used to be 4 or 5 base rate cuts people were expecting. So that's one big change. The economy's gone a bit slower recently, so we've had disappointing GDP growth data. People are debating whether that's linked to all the uncertainty around the UK budget. So Rachel Reeves came out at the end of October. There were some tax rises in there that didn't go down too well, some increased borrowing, which have had an effect of increasing bond yields. So all of that into the mix, and obviously on top of that, you've had the election of Trump, which has given the US market a boost. And of course, people can invest wherever they see opportunities. And a lot of people are looking at the US and saying deregulation, cheap energy. They're looking at the growth agenda that Trump is offering. And they're saying, well, look, actually, we're comparing the US against the UK. Now, we believe there are some great opportunities within the UK, but short term, that debate between US growth and UK in a period of difficult economic times, it's becoming a difficult choice for investors.
For a number of years now, commentators have pointed out that the UK stock market is cheap. Does it remain cheap, and how cheap is it?
Yeah, I'd answer that in 2 ways, Kyle. The first way I'd answer that would be that certainly in terms of international companies, it's actually really easy to do the comparison. You can do the compare and contrast, look at different sectors. You see some pretty similar companies. So let's think about, ExxonMobil versus Shell, for example. Or if you're looking at different sectors, you can do the same kind of comparison. And you'll find that in every case, the UK name is trading at a much cheaper valuation than the international name. Now, we see that as an opportunity. So we've got around about 55 to 60% of our portfolio in names that are overseas earners. So we've got the bulk of our portfolio in overseas earners, and we're seeing lots of attractive investment opportunities in those areas. Now, on top of that, we are also seeing some opportunities in the UK domestic area. Now, that's where there are really bombed out valuations. We have to be careful there, though, because the valuations can stay low. We're always aware of the risk that a company can look cheap, but if things don't improve, there isn't really a catalyst for that stock, the valuation to re-rate. So we're looking at UK domestics, but we're being very, very selective given the growth outlook, as I said earlier, is mixed at the moment.
The investment trust has a yield of around 7%. So when you're looking to invest in companies that are paying a high yield, how are you avoiding the potential value traps?
Yeah, that's a really important question. So for me, what's really important is that we focus on companies generating lots of cash that will allow them to invest in their businesses, but at the same time, hand some of that cash back in the form of dividends and buybacks. And we see that as excellent news for share prices as well. So our view is that income and capital can and should go hand in hand over time. And we believe that's been borne out by the evidence over the last 12 months, as lots of companies that we selected have delivered on cash flow, they've delivered on dividends, and the share prices are finally responding after a long period of waiting post-COVID. I should also add that gearing helps us with that 7% dividend yield. Because we've got a gearing facility, which is about 13% at the moment, that gives us a bit of extra ammo to be able to deliver that 7% dividend yield.
And could you talk us through some of the highest yielding stocks that you own?
Right, I think the best place to start to answer this question is the largest position in the portfolio, which is Imperial Brands, the tobacco business. So I would say, first of all, that if you cast your mind back 3 years, 4 years, the shares were trading somewhere between £12 and £14. And today they're trading in the mid-20s, so about £24, £25. So it's moved a very, very long way in a very short space of time. Now, if you asked people back in 2020, 2021, what they would think the prospects of this company would be, they would tell you it's a value trap, it's ex-growth, it's not a sexy business. But the chief exec came along, looked at how much cash this company could create for shareholders if they just focused on a fewer number of brands, a fewer number of products. So slim the portfolio down, get the business humming. That's what he's done. He's delivering the cash. It's coming through in the form of dividends. Now, if you think back, this company's not skipped a beat in terms of dividends. They're still yielding 6, but obviously the share price has gone up a lot over the last 4 or 5 years. So back in the day when people were writing this company off, this company would have been yielding 11, 12%, and people would have said, look, that's unsustainable. Well, it was sustainable. So I think that's a good example of how we can take on the market. We can say, look, sometimes share prices are too low. And it's then when we need to be stepping in and making these positions large enough that they're going to make a meaningful impact on the performance of the wider portfolio. So that's what we've done with Imperial Brands. Still the largest position. We like the 6% yield. They're also doing a similar amount of buyback. So if you add up the dividend yield and the buyback, you get to about 12% of the company's market cap being returned each and every year.
And could you pick out another stock example, potentially one that is a more domestically focused UK business?
Yeah, okay. So the one I'd pick, which is a domestic, would be Galliford Try. So this is a UK mid-cap construction business. The market cap of this business is only about 390 million pounds. So it's a minnow. But of course, it's a very important company. They provide roads, infrastructure, schools, hospitals, and all the ancillary services to industries, the UK, the public sector and the private sector. And I'd say that one particular industry which is particularly important at the moment, Kyle, is water. So as we know, they're in the headlines far too often, the water companies, for all the sewage that they're leaking out into rivers, into the sea. There's a huge amount of infrastructure work that's going to be needing to take place in the next 5 to 10 years. And companies like Galliford Try are right at the forefront of that investment. And of course, look, there's only a limited number of companies with the capability, with the skill set to be able to deliver that investment for the sake of the UK population, because we all want to be able to swim in the sea, I don't know about you, without checking the Surfers Against Sewage website. I spent half my summer doing that. I want to be able to swim in the sea without having to worry about sewage. So look, Galliford Try are at the forefront of that. I think that's fantastic for the UK that we have these providers who can do that. Now, what's happening is their operating margin is eking up. Year by year, they're delivering a rising amount of revenues, but they're also delivering a rising operating margin because the competition is tighter than it was 10 years ago. Companies are more disciplined when they're pricing for these contracts.
And if I had to push you for a third high-yielding stock, what would you name?
Yeah, I have to mention NatWest. So I think NatWest is a bank that is really well positioned for this environment that we're entering into. I mentioned earlier on about interest rates. Look, interest rates are going to remain higher for longer. We will get another base rate cut, maybe 2 base rate cuts. And yeah, that will stimulate demand short term. But the fact is there's a lot of borrowing going on. The gilt issuance in the next 5 years is meaningfully higher than people had anticipated even 6 months ago. So in order to issue those gilts, the government is going to have to price the bonds appropriately. That means gilt yields will be higher. Now, what the big banks do is they take our deposit money and they park it in gilts. So they generate a very nice spread between what they pay us on our deposits and what they generate on those gilts. And that is called their net interest margin. Now, that is pretty visible. That's pretty predictable revenues for NatWest. So for me, look, I'm looking at the current environment. I'm seeing the economy, going through a period of introspection. We've got, relatively stagnant economic growth at the moment. That doesn't matter for NatWest. They're generating lots and lots of interest income. So for me, that's the important driver, and that's why I've made that a meaningful position in the portfolio.
You touched on earlier the fact that investment trusts have the ability to gear, which is borrowing to invest. How do the current gearing levels compare to normal?
Well, currently we're running at 13% gearing, and that's within the range. Typically we're between about 10 and 15% gearing. Now, obviously, you could try to market time, but our view is actually over time, economies will grow, company earnings will grow, and dividends will grow. And actually, if we can have that additional gearing facility, that enables us to be more exposed to that stream of growing earnings and dividends, which should be in the interest of our shareholders over time.
Thomas, thank you for your time today.
Thanks, Kyle.
So that's it for our latest Insider interview. We'd love to hear from you. You can comment, do hit that like button, and also hit the subscribe button for more videos from fund managers. And hopefully, we'll see you again soon.